So the subject I want to talk about today is the idea of something being too big to fail, specifically related to the financial industry. And then that sort of leads into a discussion on why it's so important for the financial industry to be regulated. And so the biggest example in the recent past of the concept of something being too big to fail was during the 2008 mortgage crisis. So as you probably will remember, the 2008 mortgage crisis was a crash, a market crash, that happened because banks had been providing loans to individuals who should not have access to that amount of money and who should not have been able to purchase homes. They were giving out loans for $300,000, $400,000, $500,000 to people that were making $30,000 a year. It made no sense, and they were doing it because they were greedy. They wanted profits. Mortgages pay a lot of money in interest, and these people had to pay significant interest rates in order to qualify for those loans. And what happened was, as you can imagine, eventually a lot of these people were unable to keep up with their mortgages. As interest rates rose, they went under, and it caused a cascade effect of bankruptcies. And what happened was, those bankruptcies then led the banks who had given out those loans to lose a ton of assets in those mortgages, and that caused them to go under. And so one of the bad things that happened with the mortgage crisis and how it was handled is that right at the start, when the first bank went under, the American government decided not to bail them out. They decided to allow the bank to go under, and what happened was this caused a cascade effect in the market. One bank went under, and then another, and then another, and then another, and it led to a significant downturn, significant recession led by that, and it was a fairly bad one that continued on for a while. Now, what does too big to fail mean? Just to start this off, I'll start off with sort of talking about another industry and then relating it back. Let's talk about the shoe industry. So some of the bigger players in that industry are Adidas and Nike. Now, let's say that for some freak reason, tomorrow Nike had to declare bankruptcy. Who knows why? Who knows what caused it? Obviously, it's not going to happen. But if it were to happen, what would happen to the shoe industry? Well, Adidas would keep going. Honestly, they'd probably be like, hey, there's one less customer. Tom's Shoes would keep going, and all the other players in the market would be like, okay, this doesn't really affect us in a huge way at all. It's hugely different in the finance industry, though. Let's say that there are a bunch of different banks in a country. If one bank goes under because they were lending out bad mortgages to people who should not be taking out those mortgages, who couldn't pay them, and then when those mortgages went under, when they became bad debt, when people had to declare bankruptcy, that bank then had to declare bankruptcy. Here's what happens. That bank goes under. Now, the people that had money in checking accounts, typically in almost every first world country, there is insurance for up to a specific amount, typically in the hundreds of thousands of dollars, that covers those amounts in those accounts. So the people typically won't lose their money. But when a bank goes under, there instantly is a significant amount of fear in the market. In the financial industry, the pillar of the financial industry is trust. Trust in the market, trust in the banks, and trust in their quality of what they're providing. So that one bank goes under. Now you have another bank which isn't doing great. They're not necessarily on the brink, but they're not doing well. They have some bad assets, but they're doing okay. They have enough money, and it's not a huge issue for them. But when the first bank goes under, a significant amount of people at that bank then look at what happened right over there, and they're like, oh wow, a bank just went under. That's scary. Maybe I should pull my money out and, time to hide it in the mattress, maybe buy some gold, which typically will retain value. And there often will be a mass exodus from that bank. So this bank was doing okay, they weren't doing great, but when the first bank goes under and they lose a ton of customers who are pulling their money out because of fear, well, then they go under. They can no longer pay their loans, they lose money, and they have to declare bankruptcy. Then what happens? The third bank. Well, the third bank is doing fine. They don't really have issues with bad mortgages. They're doing okay. But what happens is people at this third bank then look and like, wow, two banks just went under. That's scary. I'm for sure going to pull my money out now. And what happens is a bunch of people pull their money out of that third bank. And this bank that was doing fine suddenly loses a ton of customers. Holy crap, we no longer have enough money for our mortgages. It goes under. And it continues. The fourth bank, which is doing great, they go under because people pull out. When something happens in the financial industry, when a company fails, it has a cascade effect. That's the concept of too big to fail. In the financial industry, if one company goes under, it will have a cascade effect because it will hurt the trust of people in financial institutions, it will scare people, it will cause people to run away, take their money out, and it has a huge negative effect. So that's why industry regulation is so incredibly important in the finance industry. Because if one company goes under, one company does something that's inappropriate, one company does something that they shouldn't have, it causes a cascade effect that will ultimately lead to a market crash. And unfortunately, there are not a lot of industry regulations for the financial industry right now. And you may be wondering why this is relevant, why this is important right now. Well, it's because a lot of the same issues that happened in the 2008 mortgage crisis leading up to it, with providing bad loans, with providing huge amounts of debt, well, they're happening again. And sort of the reason behind that is, well, there was no consequences for the banks during the 2008 mortgage crisis. There were no really industry regulations, nothing came out of the governments. It was a slap on the wrist. And just to sort of put it into perspective, you may be thinking, why do the banks do this? Well, let me ask you this. If, say, you're playing blackjack, and the deal was that if you played and won, you would take your money back as well as the winnings. Then if you played and lost, well, they would just give you your money back. Now, that sounds like a pretty fantastic deal. Either you get your money back and nothing really changes, or you win and make more money. Well, that's kind of what happens in the financial industry right now. Because these companies are too big to fail, if they go under, the government has to bail them out, has to stop them from going bankrupt, or else they cause a cascade crash in a market. And so, what do? Well, they're going to give out loans to people who should not have them. They're going to give out tons of debt to people that can't sustain it because they make money off that. And then in the event that those people default, in the event that they default in mass and causes a market crash, well, they just go to the government and say, well, you gotta bail us out, or else you're going to have an economic downturn. And that's why it's incredibly important we need industry regulations, specifically in the finance industry. Most other industries regulate themselves. For example, say you have the computer industry. Well, competition within that forces companies to become better on their own. They don't really need significant regulations because they're competing with each other. Finance industry, they are competing with each other, but the issue is if one company does something stupid and goes under because of it, it's a serious problem for the economy. And so there really needs to be a push towards regulation in the financial industries. And unfortunately, that's really not going to be a reality because there is a lot of influence that these finance companies have within governments, and there aren't going to be likely to be any changes anytime soon. So how do you protect yourself from these too big to fail situations that cause serious market problems? Well, one of the best ways is to educate yourself financially. Understand before going to get a mortgage if it is something that you can afford, if it is something that, if interest rates were to rise, can you still pay off this mortgage? Can this car loan, is this something that I can manage with my current income? Is this the appropriate financial situation for me? The banks are not always going to give you the best advice. It is incredibly important that you understand yourself these financial decisions so that you can protect yourself against these situations, because they are going to continue to happen until something changes in the system from the government making changes. But again, that's not likely to happen, so the best way to protect yourself is understand personal finance, understand before you go to banks, before you make these financial decisions, what can happen in these situations. In the next video, I'll talk a little bit more about what's going on with the housing market and what potentially will happen. Is it going to be a repeat of the 2008 mortgage crisis? And talking a bit more about that. As always, if you liked the content, if you found it useful, please like, share, subscribe, and it will help me grow and continue to offer content.